Good day to everyone. This will be our first part of discussions involving the trade-off between risk and return. As a short overview, we have to take note that risk and return have direct relationships in such a way that if one increases, the other increases as well. So the first one is the risk, which is normally on the x-axis, while the return is the y, which is found on the y-axis, of course. Again, that's return. Then, to begin with our discussions, there is an emphasis of the word trade-off, which basically means that there is some sort of compensating factors between the two. So we will have to dissect as to what actually composes such relationship of the two. Again, that's direct. Now, this particular graph shows us again that the risk is found on the x-axis while return is found on the y-axis. Of course, you know this from mathematics. And then we can notice that the graph here is upward sloping from left to right. And then at the bottom part is T-bills or treasury bills, which are bills issued by the US Federal Treasury Department. And then for the Philippines, of course, we also have our Philippine Treasury, and then we issue these particular bills. But then in the Philippine setting, I understand that bonds are the common ones issued by the Republic of the Philippines. All right. So government bonds or treasury bonds. But anyway, so in international setting, especially US, we have the T-bills in which we assume that they are the instruments or financial instruments, to be more specific, in which there are assumed to be risk-free rates. So in other words, the rates of returns of T-bills are assumed to be risk-free because in the real world and real sense of it, actually, we cannot, again, avoid risks as a whole, like reduce them to zero levels. Overall, or as a whole, again speaking, there would be some portion or portions of the risks that would retain. And that's the important thing. So again, that's just an assumption. And then going upwards, T-bonds and then the corporate bonds following the treasury or government bonds and bills respectively. So these are bonds issued by the government again for the latter, and then this one corporate bonds will be for the corporations. And then the bonds are actually classified or rated based on the degree of risks there are. So in terms of the risks, we have the investment grade in which they have lesser risks, and then junk bonds have higher risks. And going upwards, we have the common stock or the ordinary share or shares as we speak of. So overall, the common stock or ordinary shares have the highest or greatest amounts of risks, but also the higher possibilities or the highest possibilities if compared overall for returns. And then in analyzing, we have to take note that we look at the margin. So that's why we would be saying that there would be a return earned on investments if, of course, the marginal benefits are there for investing. So the returns again are the benefits, marginal again speaking, or incremental or additional, while the risks are the costs. And then the difference of the two would be the net marginal benefit if the returns are higher than the costs, in which such should be our focus. Normally, in the long run or long term, the returns would really be higher than the risks or costs involved, especially if we incorporate later on concepts of diversification. I am announcing this in advance, wherein we look into combinations of various financial instruments and classes. And then trade-off always arises between the expected risks and expected return, because again, there is the compensating factor between the two, or there's a difference or margin of the two. Then for financial management wise, if we value these risky assets, then that's the challenge. But this is fundamental under financial management because we have to know, even if estimate but professionally done, about the values of, again, these risky assets. So we have three procedures. First is to determine the asset's expected cash flows, whether that's positive, meaning cash inflows, or negative cash outflows. And then we have to know the discount rate or the weighted average cost of capital or the hurdle rate that reflects assets risk. And we also have to know the present value, in which the present value or the net present value is the difference between the present value of cash inflows and present value of outflows. Normally, the cash inflows would be discounted using number two, the discount rate, and then the outflows are being spent at time zero. So that's why normally the amounts provided in the problem would be our outflows. Then we call this three-step procedure as the DCF or discounted cash flow analysis. For the returns, we can express them as a total or as a percentage. For the total, this is either the gain or loss experienced on an investment over a given period of time. So for stocks or shares, actually there are two components. It would be the income stream from the investment. So in this case, that would be the dividend. Well, we just have to mention though the bonds. In bonds, we have actually sources of our cash flows in the form of interests and principal. So that's on the investment. But for the stocks or shares, the income stream would be normally dividends, depending upon the declaration of the company, because that's not compulsory or mandatory. It's actually optional on the part of the management or the BODs of the corporation or corporations. And then the capital gain or loss is the difference between the value of the stock today versus before. And then it's either a positive gain or loss negative. And what's the cost? Because the stock's values are actually, or shares values are actually dictated by changes of asset prices in the stock exchange market or markets. Then again, as what we've said, the return can either be expressed in dollar terms or in percentage terms. And then if we now look at the dollar returns, so for the total dollar return, that is actually the sum of income plus capital gain or loss. So here is our example wherein we have Terrell bought 100 shares of Microorb stock for $25. And then this is the cost before for the acquisition of the shares. A year later, you have the dividend of $1 per share, and it is now sold for $30 per share, or it can be sold for $30 per share. Because if it is sold, actually, that's a gain or loss from sale or disposal. So it is now a realized return. Whereas if it is a capital gain or loss, that is still unrealized. So it's just the value in the market. So the dollar return is 100 shares multiplied by 1, that is the dividend, and then the $5 is, of course, our capital gain. So where did we get this capital gain? Simply the difference of $30 less $25 per share. So this is now our total dollar return. Now, what about another example? So let's say Owen this time. So we have 50 shares of $15 each. This is the acquisition cost, no dividends paid. And then the selling price is $25 per share. So our computation now is it's actually 50 shares. It's not 150, it's 50 shares. And then it's to be multiplied by the difference. So 25 and 15, and that is 10, correct? So 50 shares times 10 equals $500. All right, so please take note of that. Again, 50 shares times $10 per share, which is just a capital gain, no dividend here in the second example. Then what about for percentage return? So example, Terrell's dollar return exceeded Owen's by $100. So can we say that Terrell was better off just by looking at the excess of the return of Terrell over Owen? So the answer is no. And this is where we look into the percentage returns. Since the initial investments of the two differ. So Terrell has 25, while Owen has $750 respectively. To get the total percentage return, that is total dollar return divided by the initial investment, we might be wondering as to how we got the amount. So let's go back to the previous slide. So we have here again $25 times 100 shares, that's $2,500 for Terrell, initial investment. For Owen, that's 50 shares times $15, that's $750. And then these are now the initial investments as shown in this slide. Then to compute, so of course, we can get such by having the numerator, which is the total dollar return, divided by the initial investment. So that's 600 over 2,500 in dollars. That's the cancellation of dollars, of course. 0.24 equals 24%. Using the same formula, so that's 67% for Owen. And that's why Owen's investment performed better than Terrell's did because of the percentage return. So that's how important our analysis would be in terms of percentages. Next, if you look into the nominal returns, so these are the returns which are not yet adjusted for inflation. So we can observe that the four graphs, just take note of the legends though in terms of colors. So we can notice that they are increasing over time. There might be some fluctuations along the way in different years, but overall, we can see that the graph is increasing from left to right. So looking into the stocks, it's really the topmost, and then followed by bonds and then bills, which are again assumed to be the risk-free financial instruments or assets. And then at the bottom part is inflation, which is also increasing. We also have to take note, by the way, guys, that we are here on the part of the investors or those who are placing their monies to purchase or buy or acquire shares, just like a while ago for bonds valuation on the part of the investor. So those who bought bonds or acquired bonds. Going back, so this is an interesting graph as well. So what is to be learned here is that over time, the rates actually would increase and we will accumulate the gains for as long as we are holding our assets because in the market, everything is assumed to be temporary. Now, what about for the real return? So this time it is now adjusted by inflation. So please take note that to get the real return, hopefully you still remember that's actually 1 plus the nominal rate, that's the numerator, divided by 1 plus the inflation rate. So that's how we get the real return then. So whatever is the difference, and then we are going to deduct by 1. So that would be our real return. All right. So still stocks have the highest and then followed by bonds and bills are on the last. Next, risk dimension. In terms of looking into the three asset classes or major asset classes or investments classes, bills, bonds, and stocks respectively, and then we look into the nominal and real percentages or rates of returns, and then look into the averages, best years, and worst years, we can notice again that the stocks would have the highest amounts or values for the averages, and then the best years would be the highest, but the worst years would be the lowest. And the bills would be, of course, the lowest in terms of the average returns, then the lowest in the best years for of course, the returns, but in terms of the worst years, also the lowest. Of course, again, going back to our very first graph that we have seen, that in terms of the returns and the risks involved, risks normally are the prior ones, the bills would be the lowest, and the stocks would be the highest. So no wonder that in terms of the exposures in the market for the best and the worst years, so same would be true or is true. Then in terms of the risk premium, which is the difference between our average returns with these asset classes, so from stocks to bills, that would be the highest, since in terms of ranking, stocks would be 1, bonds 2, bills 3. So we expect that the margin would be highest as compared with stocks and bonds with our 1 and 2. So the first one is 1 minus 3, this one is 1 minus 2, and this is 2 minus 1. So which is also the, 2, of course, minus 1 for the stocks and bonds, yeah, we're correct, or 1 minus 2, vice versa. And then the bonds minus bills would be actually our 2 minus 3, right? So the lowest again. Then risk premium is that additional return that an investment must offer relative to some alternative because it is more risky than the alternative. So if we select stocks, we actually have higher risk premiums than if we invest in bonds, which is at 6.5%. So this is the additional return that we get because we did not choose bonds. Then in terms also of the percentage returns, again, going back, so same is true for that. And then also if we translate that into an interesting graph, stocks here, bonds and bills last, and then this is our y-axis. So this is 0 and then positive going upwards, negative going downwards. So still stocks would have the highest average returns in terms of the years from 1900 to 2006. Then also table 6.2 would show to us the risk premium. It's just like enlarged as compared before. And then another one is all about volatility and risk. So if there are more risks on an asset class or investments, or the assets have higher or greater risks, or you can also say that these investments are riskier or the riskiest as compared to the other classes or types of investments or financial instruments, then of course there would be higher values of risks as well on the average amounts of risks as well as the returns. Again, risks and returns have direct proportions or they're directly proportional to each other. And we can also say that in terms of the risk, which is standard deviation, so equities, which is again our first ranking in terms of the returns, would also have the highest because they have the highest fluctuations in terms of their returns in the market or fluctuations of the values or amounts of the return. So volatilities as we speak of. So that's why the risk and volatility is actually incorporated in the standard deviation. So asset classes with greater volatility pay higher average returns. This is the lesson here as explained. Then we can notice as well that the average return on stocks or equities are basically more than double the average return on bonds. So that's 11.7 versus 5.2, and here also 8.5 versus 2.3. And then stocks are 2.3 something times more volatile also. So that's the reason. So more than double because well, equities actually have higher exposures to risk. So higher exposures again to such would lead to higher or greater returns. Then we can also see the distribution of historical stock returns statistically or probabilistically speaking that we can somehow create, or in a way create, a bell-shaped curve in our statistics that would show or assumed normal distribution. So we can create that particular assumption and we can incorporate concepts from statistics to get our standard deviation from the variance. So we will discuss that in the next part of this series. Thank you very much for listening and God bless us all.